In this module, we're going to talk about investing in equity securities. So this is going to be pretty similar to debt securities. However, they have their own rules. Because we have a certain different type of ownership in the company, we have actual ownership rather than just a creditor-loaner relationship with the company. We're going to take some different things into account. And the primary thing about equity securities that differentiates them because of that ownership is that depending on the amount of ownership, we're going to account for it in different ways. As you can see in this table, we have different levels of ownership, below 20%, 20 to 50, over 50. And depending on that ownership, we come up with the basis of how much control the owner has over the company. So in the case of less than 20% ownership, we say they don't have any significant influence. When they have somewhere between 20 and 50%, then they have a much stronger hand in the company in terms of voting rights, in terms of setting policies, in terms of their view in the company as significant owners. And then we're going to use a different method, which is called the equity method. For beneath 20%, we use the fair value method. We'll talk more about these two methods in this course. The third and final, the highest bracket of ownership, over 50, means that if we own more than 50% of the shares of a corporation, we are actually in control of that corporation. And in that case, we use consolidation. So we're going to cover these two in Intermediate 2, and these are Intermediate 2 topics. You might even cover equity method a little bit more in advanced, but consolidations are certainly going to be covered in advanced because they become very convoluted, pretty complex, and lots of intracompany transactions to account for. So we're going to take a stab in this module, particularly at the fair value method. The idea with the fair value method is, since we don't have significant influence, we are going to base the fair value, or the value, I should say, of our investment on the market. So what is the stock price trading at, and how many shares do I own? Simple as that in terms of recording a fair value. That's the nice thing about equity. You don't have to deal with interest rates. You don't have to worry about premiums and discounts. Since they're a simpler instrument, we don't have all those additional items that we had to worry about with debt. So let's look at how they can be classified. Again, we're under the fair value method, so we don't have significant influence in the company. And prior, we would have two classifications of securities. However, as you can see with the asterisk, there's a big and recent update. After December 2017, we are no longer allowed to classify equity securities as available for sale. Any equity security, as long as you have less than 50% or less than 20% ownership, has to be seen as a trading security. If you own more ownership, then yes, the equity method, the consolidation still apply. But anything less than 20% has to be now classified as a trading security if it's equity. So let's look at how we account for each of these items that can occur under a trading security. At purchase, we just record them at cost. Simple as that. Again, we don't have any interest rates, don't have to worry about present value of the payments that are coming to the shareholder. All we do is record the cost of purchasing those investments. Dividends, remember, we are, in this case, receiving dividends because we are the investor. So we're receiving dividends rather than paying them, which is, the normal flow you're probably familiar with as a dividend. But when we receive those dividends as an insignificant shareholder, then we recognize those as dividend revenue, typically as non-operating income. Operating, non-operating income simply would refer to whether or not it's the central operations of the corporation. You could argue that certainly certain investment brokerages might view dividend income as operating income. However, that line gets blurred a lot in practice no matter what industry it is, operating versus not operating. But realize that we recognize dividend revenue as net income when we receive it as an insignificant shareholder. When we're marketing the market, it's a very similar process to debt. We're going to use a security fair value adjustment account. It is a real account. We don't close it. It's an adjunct account. Therefore, as is the case of adjunct accounts, since this is related to an asset, just like the debt, it will have a debit balance and be increased by debits and be decreased by credits. If there's an overall unrealized loss position, it'll have a credit balance. If there's an overall unrealized gain position, then we're going to have a debit balance. This, of course, also affects net income because they are classified as trading securities. Finally, when we sell the investment, we're going to just record a debit for the sale price in cash, and then we're going to credit the investment at its historical cost. So we need to remember that we're going to record this investment at historical cost, kind of like the face value of a debt investment. If we have an equity investment, we're always just going to hold this guy at historical cost. You know, we might have a portfolio of many of these, and we no doubt will in practice. A company will have many equity securities of different companies in its portfolio, but they will all be recorded at historical cost. So like I said, yeah, this is super similar to debt investments. The only real big difference is that it's slightly less complicated, simply because we don't have that interest to deal with. Now, the thing I do see trip students up is remembering to account not just for the mark-to-market adjustments, but keep track of purchases and sales. And so for that reason, it is so important to use the investment T account. Because these are simpler, because they are very much trading in and out of the company's portfolio, I tend to test and quiz over sales and purchases at various points in time. And so just remember to update this equity investment T account, because remember, you're always going to be marking, in the case of equity investments, the historical cost to market, but this historical cost balance may have changed depending on any purchases or sales you made during the year. In terms of balance sheet effects, the security is always going to be recorded at the fair market value since they're classified as trading securities. And also remember, trading securities are always current assets. Simply because of the definition of a trading security is something that we intend on selling, that means that it is a current asset. We expect to exchange it or liquefy it for cash within the coming year. When we talk about the income statement effects, it should be pretty familiar to you. Trading securities, therefore, their change in fair value, the mark-to-market transactions, those affect net income because they're trading. Remember, we have no available for sale, so that eliminates that distinction between OCI and trading securities when it comes to debt securities. I'm sorry, when it comes to equity investments. Any dividend revenue is recorded in net income. So that's another flow that could happen to net income you should be aware of. And finally, whenever we sell them, similar to debt, we have to realize a realized gain or loss on the sale and make sure that we close out the investment from the investment asset account at historical cost. And that difference between the cash and the historical cost, that will be our gain or loss for the period. The statement of cash flow effects, which are everyone's favorite statement, essentially trading securities like debt investments, always classified as operating cash flows. So that trading category sets it into CFO section of the statement of cash flows, and it doesn't move from there. All realized gains and losses are reversed. So when we sell these guys, we want to reverse the cash flow from CFO, just like we learned in Intermediate 1. We reverse all gains and losses on the sale of fixed assets. Well, this is just similar to that. It's an investment, but we still reverse the gain or loss. Any unrealized gains or losses also have to be reversed because, remember, they don't actually reflect a cash transaction. So if I had a mark-to-market gain where I debited the security fair value adjustment and then credited my unrealized gain, just like we saw with debt investments, there is no need to mark it because we have there is no need to, we want to reverse these guys because net income, yes, this is moved by the gain. So yes, net income is affected, but is there a cash effect? No, there is no cash effect. And so we need to get rid of that gain if we're going to turn net income into cash flow from operating activities. Now, the one part of this that tends to trip some students up is when we talk about dividends. When we're paid these dividends, remember, we record them as dividend revenues. So the basic journal entry is cash. We'll say $100 dividend just to make up a number. And then we'll record that as dividend revenue for $100. The thing that messes students up is that there's an option. You can record dividend effects, can either be CFO or CFI, wherever the company would like to depict them. Now, if we're going to do CFO designation, then there's no need to reverse anything, because if you look at what the cash effect and what the net income effect are, right, they're the same. We have a net income effect that is increasing revenue, overall net income by $100, and we have a cash effect that is also reflecting the $100 that's coming into the company. Now, if we choose to portray it as a CFI, then we have a bit of a problem, because this revenue is going to be putting it into net income, and we don't want it in the cash flow from operating activities. Therefore, we need to back it out. So if we're going to go with the CFI designation, we really need to make two entries. First, we need to reverse the dividend from net income. Because if we want to report it as CFI, we need to take it out of net income. Otherwise, it's going to end up as a $100 cash flow from operating activities. It'll overstate our operating activities, because what we want to do then is disclose a $100 inflow in CFI. Now, which one would a company prefer? Probably CFO, simply because cash flow from operating activities tend to have a luster of a continual cash flow for the company, whereas investing activities and financing activities don't have that same sort of persistent cash flavor for someone who is looking at the company. So that basically goes over their financial statement effects. Let's now look at an example where we have multiple securities in a portfolio. We're always going to be looking at portfolios of securities when it comes to equity, simply because, again, no company is typically going to own just one class of securities, one company. They're going to diversify their risks, own a different amount of securities from different industries, and get that risk diversification going on. So looking at this is typically some of the information I'll disclose to you. Here we have that this company, Ledford, made some equity investments in 2001, X1, so that I can stop updating these dates every few years. By the year end of the two subsequent years, the investments were valued as followed. So we get what they cost when we purchased them, then their market value at the end of the first year, then their market value at the end of the second year. I'll also give you a little more information, because some of these say NA. Well, what does that mean? Well, in the case of Harley, they didn't purchase this one until sometime between the end of the first year and the end of the second year, and actually at the beginning of the second year. Right? So that wasn't part of the original cost listed at 11X1. Now they sold Kawasaki during the second year, on March 1st of the second year, and so that's why it doesn't have a market value here. So I'm trying to give you a little bit of practice with engaging these problems when you have some securities that are purchased and sold, because like I said, that tends to be where students get a little tripped up with their ability to work these problems. So we're going to keep that close by just because we're going to use a lot of the information there. It says prepare journal entries to record the purchase of investments. Remember, that's pretty simple. All we'd want to do is record them at cost on 1/1x1. We would have the following entry where we can just lump them all together. Honestly, we don't have to worry about separating them out. It just takes more time to write it all. So we have an equity investment, and we're going to spend cash. Always assume, unless I otherwise tell you, that we're using cash to purchase things. So the $105,000 is simply the sum of the three that we purchased at 1/1x1. Very simple. Now we have a journal entry for the dividend that Harley paid, and I have in 2x1, but Harley wasn't purchased, so that's a little bit of a problem there. That should be the second year instead of the first year. Then we would have a dividend paid, $2 dividend per share. So how many shares of Harley did we purchase eventually? We had 3,000 shares. And so we would just multiply that out to figure out how much dividend revenue I should record. Cash of $6,000 and dividend revenue. So that takes care of those two entries. Again, those are probably the simpler entries, obviously. Think about some of the effects. This would be a $105,000 cash outflow from operating activities. This would represent either no adjustment because it's already in net income. It is a cash inflow from operating activities. However, we don't have to do any adjustments for it. It's already in net income. This wire keeps falling. All right. Now comes the little bit of a meatier part to it, where we're going to want to use T accounts in order to follow the logic of what's going on here. So I'm going to go ahead and just fold this over so I can continue to use the table, and you can see everything on screen. So it says prepare journal entries to record the fair value adjustments at the end of the 2 years. Don't forget that the purchase and sale of investments occurred. So go ahead and start your T account. So we're going to have a pretty big T account here. This is the equity investments T account. When we started the year, technically, just from the beginning or the end of the last year, we had a $0 balance. We made that $105,000 equity investment journal entry when we purchased them. And so at that time, after I purchased them, I had $105,000. Now I haven't done anything else with them at that point. So at the end of the first year, we're at 12/31x1. That's the balance of those guys at the end of that year. Just looking at what I logged in as the journal entry, and by the end of that first year, I had no more purchases, I had no sales of those, and then that's where I ended up. Now, the security fair value adjustment account is what I would draw up next. Again, make it a little bit bigger because we're going to cover 2 years with this and just see how it flows from year to year. We have that account, and of course starts at 0 because we had no equity securities there. It will have a balance at the end of that first year, but we're not sure what it is yet. In order to figure that out, what we're going to need to do is figure out, well, what is the fair value of my portfolio? And I need that fair value as of the end of the year. So I'm going to look at it, and how I'm going to determine that, remember, from the fair value method, is to add up the securities that I have at the end of the year, what their market values are. So 34, 24, and 75. Adding those together gives me 133,000. Then I just look at, all right, well, in order to mark my securities to market, I have to go from 105 to 133. That means I need $28,000, and it's a gain position, so I want to mark that as a debit so that as an adjunct account, the balance of my adjunct account increases the balance of its parent account to reach the fair value at the end of the year. Now, remember, when we're doing this, that is the balance where always the difference between what I have as historical cost and the fair value, That's the balance of the account. The adjustment, and I'm doing it in a different color just to make it that much more painfully obvious, is going to be the amount that I then journalize to make this happen, right? The security fair value adjustment account just doesn't appear with a $28,000 balance. We actually have to put it there with the journal entry. And so we're going to debit security fair value adjustment by $28,000. And we're going to recognize an unrealized holding gain, or just an unrealized gain, so you don't have to write too much. I know what you mean, is what we need to record to get there. Now, whenever you start with a $0 balance, of course, that's going to equal, the change is the amount that's in the balance by definition. But we need to be careful, because if we're working from balance, as we will be in the second year, we have to make sure that we know the difference between what gets journalized and what represents the balance I want to increase the parent account by. So working through the second year, I'm going to go ahead, and even though I didn't ask for it in the problem, I'm going to make a couple of journal entries so that we are crystal clear about what's being updated. Remember, we sold the security and we purchased the security. We sold Kawasaki for $95, so we can journalize that. We also purchased Harley for $102. So I'm going to record the purchase of Harley here. Again, pretty simple. Equity investment, $102,000. Cash, $102,000. Don't forget now, come over here, update your equity T account, because now the balance of that has shifted since I purchased more. Now then I sold Kawasaki for $95,000 on 3/1 in the second year. And when I sold them, I received cash of $95,000. I want to credit the equity investment account by the historical cost. So that's another thing I see people mess up. They'll go and grab $75,000 because that was the most recent market value. But remember, this equity security, since we are crediting the equity account, it was originally put in there at the $50,000. We didn't touch that. We made all the mark-to-market adjustments here in the security fair value adjustment account. But we don't want to do that 75. We want to go with the 50. And then that gives us a gain on sale for $45,000. Again, go over and update your equity investment T account to reflect that $50,000 of historical cost was removed. And then after we rebalance the account at the end of the year, I now have $157,000, and this is at December 31st, year 2. So now we again have to market to market. We look at the market value of what we have remaining. We sold this guy, it's 0. We have 43, 27, 110. That comes out to $180,000 fair market value. And in order to have my investment account appear at this amount on the balance sheet, I have to then figure out what balance I want. I need a $23,000 balance in order to get that there. So 157 plus 23 gives me that amount. Remember, that's how adjunct accounts work. Now, even though I'm in an overall gain position, my portfolio experienced a loss during the year. Because I was at a $28,000 gain position, now I'm at a $23,000 gain position. Well, that means that I have to make an adjustment of $5,000, but on the credit side. And because I'm crediting this account to get to the desired balance, I now have to create a journal entry that marks it down. So I have a credit to the security fair value adjustment for $5,000, and I have an I have an unrealized loss of $5,000. Now, this unrealized loss, where so there's some doubts that come into people's mind because they say, "Wait a minute, right? How am I recognizing a $45,000 gain on sale when really that security, and this is why they like to use that 75,000. They say, really, that security, it only really had a $20,000 gain because I already put that $25,000 price appreciation into net income in the year before, right? So it seems like that 45,000 is overstating things. It's not. It's not, because part of the reason why we had such we had a loss here is that we, when adjusting this portfolio, reversed $25,000 gain that we had recorded in the prior year. So in order to show that to yourself, what I would like you to do is to see what would have happened to this portfolio of securities if I had just looked at the movement in price from the end of year one to the end of year two, right? So this would have been a $9,000 appreciation. This would have been a $3,000 appreciation. That's a $12,000 gain. We purchased Harley at 102. That's an $8,000 gain. So if we add up all of that, we have 9,000, 3,000, that's 12, 12 plus 100 at 2 to 110, that's 20. We should have shown for that period a $20,000 gain, but we didn't. We showed a $5,000 loss. Why? Because we reversed the $25,000 gain we had recorded for the purchase for the security that we sold. We had to reverse that because we recognized not only the gain that it had, that $25,000 in the first year, but also the $20,000 it appreciated even further from 75 to 95 in the second year. You might have to go back, replay that portion of the video a couple times just to hear it all, to follow it along. We'll talk about it again in class, but it's just really essential that you understand I didn't have to reverse this item individually. I didn't have to go in and reverse the security fair value adjustment account for $25,000 when I sold it, because when I went and rebalanced the portfolio at the end of the second year without that guy there, after selling it, it reverses itself. Okay? So let's go ahead and classify all these effects. We have only net income effects because, again, we have only trading securities, which is a nice departure, nothing to think about. Really, the only thing that goes into OCI is unrealized AFS, gains or losses on debt investments. So it's not really that big of a deal to remember the differences. And if you're ever in doubt, the best idea would be to go ahead and throw it to NI, because that's going to be the majority of our transactions. We have dividend revenue, and that occurred in the second year for $6,000. We had some unrealized gains and losses. We had a gain in the first year and a loss in the second year. I'll just go ahead and throw them on the same line just to save some space. Not necessary, but just how I have it recorded here in my notes. We had that gain in the first year, the unrealized loss in the second year. But don't forget, we also had a realized gain when we sold that security. And we had that realized gain come in at $45,000. And I'm not using the final line just because I combined those two. Then we move over to what would be on the balance sheet for these guys. Remember, the trading securities will always be reported at their fair value. So it will be $133,000. And again, that is the confluence of these two accounts. 105 plus 28 gives me 133. That's what I drop down on my balance sheet. 157 plus 23 gives me 180. That's what I want to put on my balance sheet as their year end. Now, the statement of cash flow effects, not quite as confusing in my opinion as the debt investments. You just have to make sure you track them all. So we had purchases and sales of securities. So that goes to CFO. And those both happened I'm sorry, we had purchases in both years. And then we had a purchase in the second year for 102,000. But then we also had a sale of a security for 95,000. So we would offset those two and then have an overall effect of negative 7,000. Now, whether or not you combine them or not, to me, more detail is better. That way I see exactly what's going on in your work. Then we have the reversal of a realized gain. When we sold that security, I need to get a better piece of tape. Hold this sucker up. Really annoying. The reversal of a realized gain is 95,000. I'm sorry. I'm looking at the wrong place. The realized gain was 45,000. So we're going to reverse that. And then we have the reversal of the unrealized items. We had a gain and a loss. The first year we had an unrealized gain of 28,000. We need to reverse that. And in the second year, we had an unrealized loss of 5,000, and then we need to reverse that. Okay. So we're going to end this video on that problem because then we're going to jump into equity method accounting. It deserves its own video. We'll talk about this more in class, and thank you very much for watching.